Okay. Are we on? Yes. Okay. Thanks, everyone. Please take a seat. Good morning, everyone, and welcome back to Bruegel's annual meeting for a one-hour session on European macroeconomic governance looking forward. So my name is Gregory Kless. I'm a senior fellow at Bruegel, and to be honest, I'm really excited to share the discussions that we are going to have today. Actually, there are three reasons why I'm excited. First, because I have an amazing panel with me, a bit original too. It's not the usual suspect that we have every year for our panel on macro governance. The second reason is actually I've devoted most of my time at Bruegel in the last 10 years working on this topic, so I'm really happy that we talk about that. And actually, the third reason is that it's a bit of an emotional moment for me because it's my last Bruegel annual meeting before I leave Bruegel at the end of October, before moving back to Paris and moving to new adventures. So I'm really happy to be here with you. And so basically, the idea of this session is to discuss, as the title says, about European macroeconomic governance. And actually, this has radically evolved over the last 10 years. As you all know, and as it was reminded in the previous session with Minister Calvino, the new fiscal framework is currently discussed heavily in all capitals and in the Council. And I guess we'll have to come back to that conversation at some point. But it's not the only thing that has been changing. Last year, for instance, the European Central Bank announced a new tool, the transmission protection instrument, to avoid the liquidity crisis in sovereign bond markets of the euro area. Actually, since 2012, we also have amazing tools that have been really useful. So European Stability Mechanism, the ECB's OMT that help us end the euro crisis. During the COVID crisis, we also created new tools, Next Generation EU, and for the first time, we built a pretty sophisticated, even if temporary, EU borrowing capacity to finance Next Generation EU, and this was seen in some quarters as a Hamiltonian moment for Europe. Now we are starting discussing new challenges. As it was reminded, now we're talking about European public goods, strategic investment, etc. And so overall, it seems that we have actually made a lot of progress in the last decade. And if you had asked me a few years ago if we were in this situation today, I would not have believed it. So I think I want to start by saying, yeah, it's great to have made progress. However, there might be some pieces that are still missing. And so that's what I want to discuss here today. What pieces of the macro governance puzzle are still missing? And actually, what should be the priorities for the next Commission? Because we know that there are going to be an election next year, a European election next year, and so there will be a new Commission. And so what we want to discuss today is what should be in their strategic plan as far as macro architecture is concerned. So that's the main question I would like to answer. I would like you to answer today as much as possible during this session. So to discuss these very important issues, I'm delighted to welcome four amazing speakers that will be able to reflect on these issues from different and I think very complementary perspectives. And so we'll have, in order of appearance today, first Judith Hermes, who is the Director General for European Policy and International Financial Policy at the German Ministry of Finance. Then we'll have Alexandra Roulet. Alexandra is now Assistant Professor of Economics at INSEAD, where she's just back, I think, this week, after being the macroeconomic and public policy advisor of the French President Emmanuel Macron during at least 1 year, I think. Then we'll have Andrea Cironi, who is the chairman of the board of Generali, as well as a professor of banking and finance, and also since November 2020, the president of Bocconi University. And last but not least, we'll have Rolf Strauch, who is the chief economist and management board member at the European Stability Mechanism. So thanks to the four of you for accepting our invitation. We are really glad to have you here. But before I give you the floor, let me just quickly explain how we will proceed. So we'll have short introductory remark, not more than 7 minutes. I told you, I hope you'll respect that rule. And this will be followed by a discussion between ourselves. as well as some questions coming from our audience. And so for the audience, for those that are present in Brussels, you can try to use old-fashioned mic, even though I think it's going to be difficult because I don't see the audience. So I'm not sure I'll be able to select people. So actually, like Jeremy, I think I encourage you, even if you're here, to use Slido that you can access on your phone. So it's either on slido.com with the hashtag governance, or you can find it also on Bruegel's website. So on the webpage of our event, you can ask, I think, directly the questions. So without further delay, let me give the floor to Judith. So Judith, thanks again for joining. So when we discussed a bit to prepare today's event, you told me that we should not only think about crisis management tools, which we have discussed a lot in the last decade because we have seen a lot of crises, but we should also think about other important post-crisis challenges. And so maybe I would like to hear from you what do you mean by that, and can you tell me a bit more about this?
Yeah, sure. Thank you very much for the invitation. Glad to be here with all of you. So you just reminded us that the European macro governance framework has been a major construction site for most of the last 15 years. And that was absolutely necessary repair and reform work in response to a number of crises and major shocks. It has resulted in the creation of new institutions, first and foremost the ESM, better banking regulation, supervision, increased policy coordination in a number of areas, and even in a new European emergency financing arrangement, Next Generation EU, with the RRF at its heart. And there are policy areas where this work is undoubtedly not finished, and I think, Andrea, you will talk a bit about what that means in the financial markets context. And we will definitely see new crises and new exogenous shocks in the years to come, which then may require a further refinement and adjustments in our macro governance setup. And I will by no means advocate for complacency here. But Gregory, when you threw the question at us panelists, what should be the priorities for the European macro architecture in the years ahead, and what pieces of the puzzles are still missing, I came to the conclusion that I would like to use my intervention here to somewhat challenge your question, namely, are there actually missing pieces in the puzzle of macro architecture for the challenges ahead, or do we actually know very well all the pieces and have them at our hand and should just use them, even if it seems maybe more interesting intellectually for a think tank to always think about new pieces which may look brighter, more colorful, or I don't know what. And I assume we have broad consensus in this room that one of the main issues for the years to come is the question how the EU can maintain and even improve its global competitiveness against the backdrop of the challenges of the twin transition, geopolitical tensions, and policy choices made in other parts of the world. And I think that we will not successfully work on our competitiveness if we stick intellectually in our doing and thinking to crisis mode and concentrate on further refining and expanding crisis tools and facilities or capacities and search for missing pieces of the puzzles, but that we need to put more emphasis and action on core issues of competitiveness and resilience, both on the level of member states and on the European level. And let me briefly elaborate what that means in two policy fields, economic policy and fiscal policy. And I have to put a spoiler at this point. I did not bring any new groundbreaking ideas from Berlin. But I think it's worthwhile to highlight and underline what I think most of us know. So my first point is economic policy. The single market is a key asset for the EU, and I think it should be the focus of our economic policy ambitions. It will only remain attractive if we create the right framework conditions, both at EU and member state level. And for this, we need truly integrated energy markets. We need to accelerate planning and permitting procedures and reduce bureaucratic burdens instead of constantly inventing new red tape. We need a strengthened skill-based to cope with demographic challenges, and we need well-functioning and modern public infrastructure and an environment that fosters innovation. The German government endorsed the so-called Growth Opportunities Act last week, and that piece of legislation addresses some of these issues. And I'm looking forward to the SME relief package, which the Commission will present next week and for which we've been waiting quite some time. We need to work harder on improving framework conditions for private investment. The investment needs for a strong digital and net zero EU economy are simply too large to focus on public money alone. CMU is the buzzword here, and I think, Andrea, you will focus on that. And an additional important part of our economic policy agenda must be keeping supply chains open. We should pursue an ambitious trade agenda that broadens market access and fosters diversification. Global economic integration has contributed immensely to growth and well-being, and we should not lightly jeopardize that, and we need to walk our talk. Addressing these challenges, which we all know very well about, will put a strain on public finances. And public finances are already stretched in some member states, and that brings me more or less naturally to fiscal policy, my second point. And my first point here is prioritizing spending for modernizing our economies will be absolutely necessary, and it will contribute to enhancing the quality of public finances. And this is important for national budgets, but it is also true for the EU budget and the MFF. We need to put more emphasis on defining European added value and what European public goods really are against the backdrop of recent challenges. Now, when we talk about the MFF midterm review, but even more so in preparing the next MFF for the next period. I said at the beginning that we were very successful in building a crisis architecture over the last 15 years. Looking back, I think we were less successful in the return to policy for normal or even good times before the pandemic. And this is especially true for fiscal policy. The increased spending during the financial crisis was not followed up with sufficient counter-cyclical consolidation efforts in good and in normal times, which we had. And we did not reduce debt levels and rebuild fiscal buffers in a sufficient manner. But those measures are absolutely necessary to prepare for the next crisis, which will come. And this time around, we should not fall into the same trap again. We need to find and coordinate a way to exit the public spending mode of the energy crisis. And we need to find a way back to normal. Just allow me one last quick remark on fiscal rules and the ongoing reform debate. The design and the implementation of the fiscal framework is key for the stability of the EU and the monetary union, and we need to get this right. Without sound public finances, we will run into a situation where our ability to act in times of crisis is severely diminished. And from my perspective, in our view, the EU fiscal framework needs common rules in form of clear quantitative criteria, especially numerical benchmark and safeguards. And the aim is to achieve falling deficits and thus falling debt ratios in a realistic while ambitious manner. To sum it all up, we have achieved a lot in improving the macro governance architecture. And looking at the challenges ahead, I believe it is important to access the crisis mode in our policy designs, return to market-based economic policy, and prudent fiscal policy to preserve European competitiveness in the years to come. Thank you very much.
Thanks very much, Judith. Let me now give directly the floor to Alexandra. So, Alexandra, in our discussion, you also mentioned actually European public goods and strategic investment as something important for you, but also mostly important for Europe in the next few years. Could you tell us a bit more about this, about what you think should be those strategic investment in European public goods?
Sure. So first, thanks a lot for this invitation. It's my first time here at Bruegel for annual meeting. I'm very thrilled to be here. Also, I just want to mention that even though I worked for President Macron until last week, nothing I'm going to say should be quoted as official, or I'm speaking in my own name. So that being said, I think, I very much agree with what you said at the beginning, that the conversation about macroeconomic governance has changed over the past decade. But another view could be, one could also argue the opposite, which is to say, look, we've been discussing macroeconomic governance for decades now. And in some sense, some of the basic economics reasoning, like what kind of fiscal policy does a unique currency call for, are the same that they were at the creation of the euro. And, this would lead to some kind of view like, experts have been knowing for some time, for a long time, what properties would be desirable. They can agree on that, but then at the end of the day, forget about economics. It's all about politics. In the not so good sense of the word, it's all about countries' diverging national interests that are going to shape the outcomes of European macroeconomic governance. Now, I think this is not my view. My view is not that the conversation among experts is the same as it was, at the creation of the euro or a decade ago. I think there has been very important changes conceptually and also concretely, and I will just mention very briefly what these are in my view. And I also think that it is not so much the case that it is less and less the case that countries within Europe might have sometimes diverging national interests. I think we have much more in common as time goes, and I will explain why I think that. So the first point is about the conversation not being the same over and over on this topic and what has fundamentally changed. So there's many things that have changed. I just want to stress one point, which is what you said, which is that we are now, I think, much better equipped intellectually to think about the green transition and the impact it will have on our macroeconomy. So there is very exciting research and work on the impact of the green transition on inflation, how this affects the policy mix. This is all very important. There is also very important work on quantifying the amount of investments that the green transition will require. And here I want to praise the work of Jean Pisani-Ferry, who is somewhere in the room, and Selma Mahfouz, who handed a report to the French Prime Minister a couple months ago, where they did remarkable work on the impact of the green transition on our macroeconomy, but also on quantifying, with the help of the SGPE, the amount of investments that will be needed for France. And I think we can debate about the exact amount. We can debate about the share of public investment within this amount of investment. We can debate about methodology. But, one takeaway that I think we cannot much debate is that it will require lots of investment. And we are now equipped to take this insight into account in a way that we were not a couple years ago. And I think that, moreover, these investments might not be growth enhancing in the short run. And this is something we have to take into account. So I think this is an important fact that we will need to keep in mind looking forward. Now, this is about kind of the challenges and what we need to do more, and it's not easy. I also want to stress that we've made a lot of progress concretely, not just conceptually, and that we should also acknowledge what we have been able to do very well, and we should be proud of this, and you already mentioned some of this. So, the way we handled the pandemic and the energy crisis in ways that were, really learning from the mistakes of the past is something that we should be very proud of and keep building on this progress. Now, the last point I want to make, because we have to be very short in our remark, is the fact that I think compared to decades ago, and this is something that was stressed by Mario Draghi in his Feldstein lecture in the summer, is that I think going forward, Europe might be facing more common shock than asymmetric shock than in the past. And this is something that has implication for thinking about European macroeconomic governance looking forward. So, when you look at the context, COVID crisis, energy crisis, this all made us realize some of our vulnerabilities, dependency, the risk due to supply chain fragmentation. You look at geopolitical tension, the rise of the US-China rivalry, you look at the rise of protectionism, you look at the necessity to decarbonize our economy. What this is all putting at the forefront for us is the importance of sovereignty, the importance of autonomy. Not, in my view, not for individual countries, but for Europe as a whole, in order to have Europe on the map. And I think that this is something we should really have at the center of our reflection when thinking about European macro governance going forward. So we cannot just talk about macro governance without talking about industrial policy, energy policy, trade policy, to make sure that we secure supply chain, European production of energy, and so on. Of course, this goes well beyond the panel. And, again, I want to stress that economics is very important. I'm an economist by training. Public finance sustainability is extremely important. And we were asked not to focus too much on the reform of the fiscal rules currently ongoing. So I'm not going into the details, but I want to make very clear that sustainability of public finance is key. Growth-enhancing reform is key, and I'm very proud to have worked for President Macron over the last year, where he implemented so many reforms that were, destined to boost potential output in a country which does not like reform. So I think all of this is absolutely key, but this should not make us overlook that we also need to finance the priorities of the Union for energy, for, the green transition, the digital transition, defense, and that these are priorities on which there's a lot of externalities, where each country benefits from the other country's investment, and where we really need to think European as a whole, and that these are not necessarily growth enhancing in the very short run. But we have to take these investments extremely seriously when thinking ahead.
Thanks very much, Alexandra. I guess we'll come back to that in the discussion. So now, thanks to Andrea also for being here. So Andrea, the floor is yours. For the moment, it's true that we have mainly discussed about these new challenges, green, digital, etc. But I think you also believe that the current architecture is not yet complete, and in particular in the financial sector. So could you tell us a bit more about this?
Thank you, Greg, and thank you on my side too for this invitation. So I'll make a very quick introductory remark along the lines of the comments of Alexandra, and then I'll touch upon quickly on two points. So my introduction is, if I have to say, how do I see macroeconomic governance in Europe evolving over time? I would try to remember that we arrived to the monetary union and an ECB because, and I'm sorry if I'm a bit academic on this, but because of what has been called an inconsistent quartet. So the fact that in an economic area, you cannot have at the same time four things. One is free capital movements, free movement of goods and services, fixed exchange rate, and independent monetary policies. And we all experienced that before the monetary union, and we had to give up one of these. So yes, it was a decision, a political decision, but it was in some way inevitable if you wanted to keep all the rest, okay? And I think that what we're facing now is, and it's been highlighted, of course, by others, is an inconsistent trio, which means that you cannot have free capital movements, fixed exchange rate, and independent fiscal policies, and especially together with financial stability. And I think there are examples where we see that. Even in a country that went out of the EU, in the UK, remember a short time ago when a prime minister announced a completely deviant fiscal policy, there was an attack from the financial markets, the sterling precipitated, and so on. And I think you can also see in European countries, think about my country, electoral promises, but when you get to the government, you have to stick to this, fiscal strong interdependence. So I think we need to move forward in that. Now, coming to more specific points, I'd like to address two. One is the capital market union, and here I'm very much aligned to what Judith was mentioning. I mean, Vice President Calvino was saying earlier that in terms of the banking union, there was a lot of progress and then a setback. I think in capital market union, the progress has been very limited. Families and firms in Europe are mostly being funded at the domestic level. The capital markets are still very much fragmented. And I'm saying that I'm aligned to what Judy was saying because I think this is a crucial point for the area competitiveness, okay? Having an integrated capital market. If you compare that to the US, in terms of equity funding, for example, most European companies' equity are unlisted, and that's exactly the opposite in the US. If you look at the fixed income market in terms of a share of GDP, the EU market is 1/3 of the US one, okay? So I think significant progress should, I mean, we're talking about what should be the priorities of the next Commission. I think this should be a clear priority. Progress should be made. Obstacles to cross-border capital flows investment should be removed. I think gold plating on the side of the national regulators of capital markets should be abolished. I think more power should be given to ESMA because that is clearly limiting the possibility of an integrated capital market. And I think that, as recently highlighted also by Fabio Panetta, a member of the ECB Executive Board, a European safe asset should be quite clearly introduced. I mean, a unique risk-free benchmark. I think that's crucial for a united capital market. The second point I'd like to touch, which is closer to my role at Generali now, which is, by the way, the largest insurance group in Europe. And if we look at the European insurance market only, it's the largest group, is the European Insurance Union. I mean, we have giants like AXA, Allianz, and Generali currently being supervised by national domestic regulators. I think this is a bit anachronistic. We would need to have a European Insurance Union which would make the market, the industry, the insurance market and industry more efficient, well-functioning, and of course for the benefit of the consumers or the buyers of the insurance products. I think here too, it would be extremely important to prevent gold plating, which is taking place rather often at the domestic level, and this would be needed to have a real level playing field, okay? I think that if we want to move to a European Insurance Union, we should follow the steps that have been adopted for the banking union, i.e. being gradual. For example, you could start by giving more power to EIOPA in terms of their ability to, let's say, harmonize regulation, and maybe in a second step to be the body that approves the internal models of insurance groups. And finally, of course, a real and proper European authority. Okay, so I think this would be crucial. Second, restricted, meaning that, like it happened for the banks, this would be applied to the large insurance groups in Europe, not to all, okay, because there would be no need for all. And finally, with a joint effort, like it happened with the banking union, i.e. The banking union, as you know, relies on joint supervisory teams where people from, experts from different authorities jointly work in the supervision of large banking groups. The same could be done for insurance groups. So I think that if you apply these three features, it might be easier to get an agreement in this respect. So those are the 2 points. Thank you.
Thanks very much, Andrea. Let me now give the floor to Rolf. So, Rolf, you're the chief economist of the ESM. As I said at the beginning, the ESM played really a crucial role in solving the euro crisis. However, to say the least, it didn't play such an important role during the COVID crisis. And its reform has also stalled since 2019. So what do you think the future role of the ESM should be, either in future crises or in preventing future crises? And what potential changes are absolutely needed to ensure that the ESM can play that role?
Thank you very much for inviting me here. And I think, as you said, as we heard, the ESM is the permanent euro area crisis mechanism. And as such, it's also very pertinent that we ask ourselves how we can, in the future, contribute to resilience and efficient crisis management. And it was said before that the infrastructure of Europe to manage crises has evolved tremendously. And obviously, we have gained a lot of resilience over the past decade, 1.5 decades, since also the EFSF was created. At the same time, it's clear that some of that was done ad hoc. There was a rapid response. Some of this is temporary. Notably, SURE has already expired. Next Generation EU, that came up during the pandemic, will expire in 26. There were complementarities that were not necessarily explored. So the question is, how will that go forward-looking from an institutional setting? Can we sort this out? Can we improve on that? And part of that picture is also then obviously thinking about ESM. The second point that we heard before from Vice President Calvino when she discussed with Jeromine is this issue, well, the world is evolving, so is the nature of crises. And it was mentioned before, Mario Draghi saying maybe in the future we face more common shocks. For sure in the future we have higher risks of climate-related shocks. That is something we basically can take as a given. And that differs in a way from the shocks that we know from the past. I mean, EFSF, ESM, was created in the context of what was more kind of a traditional balance of payment shock as we knew it, also from IMF history, where there's a certain toolbox that you can use in order to go there and deal with it, or a certain approach. So the point is the question, how can we make that toolbox that the ESM has also fit for the future, and how does it fit? And this is exactly these two elements on the evolving overall nature of the institutions in Europe and what is the toolbox of the ESM that we need to look at. And that is actually also what we are currently discussing with member states. And the background of this is as you said, pending, or not pending, the ESM treaty change that still has to be ratified in Italy, as we know. I'm count on it that this ratification will happen. And that is, for me, a very valid and good starting point. I mean, part of that change treaty is that the ESM will be an important backstop for the banking union, will strengthen the financial arm of banking union, and that's very important to have it as a backstop for bank resolution. The other part is that ESM, in a way, should also be in a position to act preventively, somewhat more preventively as it was meant from the start. We have precautionary credit lines. And the question is then, how can we use those instruments usefully in the future to address future problems and improve resilience? Improve, for example, elements of climate change, where you don't need the same kind of macro conditionality that you need when you have a structural adjustment program. But you can have different approaches. What would be a good tool if there is, for example, the threat of a war for those countries that may be affected from a market perspective? And how can one use the tools that we have in order to be helpful in those situations? The toolbox that we have overall, the instruments, are rather flexible. We have shown this also when we adjusted part of it we adjusted those credit line to the pandemic support facility. You mentioned, yes, it was not used, and we have no illusion. It has to do also with the stigma of the ESM, but it has also to do with very specific circumstances, among others, negative interest rates that made financing very easy. We don't know, or at this stage, that has changed drastically, and we don't know how it will look in the future. So I would also not put any kind of prejudice on future uses of ESM when we think about effective use, efficient use of our instruments given that specific experience, because that may change. The other point that is, I think, worth reflecting is in that context of interplay with other institutions, the efficiency of the instruments is, could there be more complementarities between the tools that the European Commission has, that the EIB has, that they offer from member states to manage resilience with ESM instruments, and what is the access point then that can be created for this? So I think there are a couple of open questions that should be answered in the context of the discussions with member states, on which we try to have a discourse with member states, and then we see how that discourse will evolve and how we can actually move towards solutions, efficient solutions for the future. I think I, for the moment, can leave it with that.
Thanks, Ralph, and thanks to all of you for those introductory remarks. Let's now turn to the second part of our session, which will be relatively short, but I see that we have a lot of questions on Slido, so I would like to share those questions with you. And let me just ask maybe one question to each of you, both mixing my own question and the question that I see from Slido. So let me start with you, Judith, and one of the questions that is asked on Slido, and sorry to come back to this topic, but you all actually alluded to, which is the reform of the fiscal rules. But you also discussed during your introductory remarks the fact that we need to improve the quality of fiscal policy. So do you think the proposal by the Commission and what's discussed now in capitals as far as fiscal rules are concerned, do you think it's fit to properly recognize those new challenges that we face? Here on Slido, they mentioned security, defense, investment, but you also mentioned green investment, digital investment, etc. Are these taken into account enough? Because there are no exemptions in the proposal of the Commission for green investment, for instance. So you can delay a bit your adjustment path, but it's the only thing that is there, and it's not specifically for green. So do you think fiscal rules should take into account these new challenges?
Well, first of all, I would like to point to the fact that in the rules as they are, there is room for investment. We have an investment clause in the rules.
Now we have.
Yeah, now we have. In the proposal, from our perspective, you're not surprised, you know that, we don't think that the proposal, as it was presented, is ambitious enough to really reach the goal of sound public finances. And of course, there has to be room for investment, but first and foremost, it's the responsibility of the member states to create that fiscal space and to make political choices and to prioritize in their national budgets for what they want to spend the money. And when I see the questions on Slido about a golden rule, is there enough room for security investments and so on and so forth, I think capital market, financial markets are agnostic when it comes to what the state spends the money for. And I don't know if a golden rule has ever worked anywhere. I mean, you know, we changed our system in Germany more than 10 years ago because the rules we had did not work. And the debt brake, our national debt brake, is heavily debated. But we still believe that it is the right way to go for us on the national level. And I'm not convinced that creating exemptions for defense, climate, be the purpose in itself good and worthwhile spending for, that those purposes should grant or should be exempted. Because at the end of the day, debt is debt.
Yeah, so the fiscal rules should be more about debt sustainability, and the quality of public finance should be under the responsibility of the member states.
And then it's about political choices, and those choices are hard to make. Yes.
So, Alexandra, I want to intervene on that question. Actually, I wanted to ask you a related question, but maybe you can both reply and at the same time answer my question. I wanted to because you mentioned strategic investments, so I wanted to know, how do you think we should finance them? And should we have some tool at the EU level to finance them? Is that necessary or not?
So, I mean, just to kind of rebound on what, I also don't think that a golden rule would work in the sense that, and again, this is really speaking in my own name, not involving anyone in France, but I don't think it would work because then, you know, it is not capped, and that's the problem. You can just exempt whatever. And I totally agree that, you know, public finance sustainability is key, and for that reason, this would not work. However, I also think that you could have a variance of some kind of rule that would still be more favorable to investing in public goods. For instance, you could imagine some kind of rule where you would allow for investment in public goods or strategic investment, but capped to kind of something very sufficiently small so that it doesn't threaten the sustainability of public finance, yet it is still treated separately. And the reason I think it is important to treat it separately is that we have to acknowledge the new fiscal rules. They are trying to achieve sustainability of public finance, which again is key. However, the European Union is also trying to achieve net zero carbon objective, a net zero objective by 2050, which is also key. And I think in the very short run, these two objectives do not necessarily go hand in hand. And somehow we have to allow for the realization of the fact that the European Union might be pursuing some kind of conflicting objectives. So we should not go in one direction which would compromise the sustainability of public finance with some kind of golden rule. However, we should also not go in a way where we put sustainability of public finance above all the other objectives and do not allow for the investment needed. Because of course we can prioritize, and you know this is true. But there is a limit, I think, you know, when you look at the numbers of the investment that would be required, and then you look at what you can do with prioritizing and changing your expenditure, and all this take time, and these has social cost, and so on and so forth, I think something in the equation is just not right. So that's, you know, again, thinking in my own name, I think there is probably not enough taking into account the importance of strategic investment in the current rules. And in particular, this is made worse, in my view, by the very stringent numerical benchmark. So the spirit is important, you know, but we have to take into account the fact that we have different objectives at the European Union level. And so when it comes to financing, you know, I think again I think the fiscal rules is one way where we should think about the financing, by allowing a bit more flexibility to allow for the financing by member states for these investments. So, you know, it could be taken into account, not just in the path, but, you know, in the adjustment that is required. If we end up, you know, with numerical benchmark, you could exempt in a very capped way some expenditures that would be, that would be targeted for strategic investment that would in fact benefit all Europe.
But moving away from fiscal rules, do you think we need a European tool to finance those public investment, or can we just use the budget and reform the EU budget to make it more fit for those challenges and focus more on European public goods, or do we need an altogether new tool?
I mean, this is a discussion that we should have. I don't know exactly, you know, what would be the best tool, but you know, I think we should for sure think about it and try to move forward.
I don't know if Andrea or Rolf want to react to this question. Otherwise, I have a question for you. But so, Andrea, the question I wanted to ask you, because you mentioned benchmark in the financial market, and the fact that we need to have a risk-free EU interest rate that is very important for European financial players. Actually, since the COVID crisis, we have a Next Generation EU, which is financed through EU debt, and actually the EU has been issuing a lot of EU debt that that can be considered as a sort of benchmark, even though the interest rate is still higher than the German rate or even the French rate, or according in some maturities, even to the Spanish rate. And there is also the ESM bonds that have been issued to finance ESM programs. So we already have EU debt. What do you think we should do about that? Because actually, now we are putting in place, implementing Next Generation EU, but after 2026, it will be finished. And so this debt will little by little be reduced until 2058. So does the financial market need some new EU debt to have like a stable level of EU debt because it needs it as a benchmark?
Yeah.
What's your view on that?
So just one very quick comment on the debate that we were having. Fortunately enough, I'm not in policy making, but as a European citizen, sometimes I have the impression that all these discussions and negotiations have an underlying problem, which is the vision for the future. So what is the vision that we have of Europe for the future, right? And of course, if we agree, if we manage, which is very difficult to agree on that, then you step back and it's easier. So to me, for example, as a European citizen, I would see a vision for the future where some of those issues, defense, transition, and so on, would be entirely funded by the EU as a whole, right? And where there would be no veto power. I mean, coming to the point you raised, I mean, in the US, you don't have South Dakota blocking everything. I mean, then we have... so I think that when you have a vision for the future, then you step back and you say, okay, these things, rather than being deducted by the deficit and so on, you can, fund them in... But let me stop here. Now, yes, you're right, but I think that very simply, I mean, in the financial markets today, the proxy for the risk-free rate is the 10-year bond, I think we would need to have, and it is a proxy. So I think we would need to have common debt guaranteed by all the sovereigns in a federal system, which would represent the real risk-free benchmark. And having a risk-free benchmark is very important in an integrated financial market. So that was my simple point. And as you highlighted, because this is going to disappear in 2026, later on it will gradually disappear. So that is my point, okay?
Thanks. Rolf, I don't know if you want to react, or I have a specific question for you on the ESM.
From my perspective, maybe two elements that I would like to add. First, maybe also to clarify the link that ESM has with the fiscal rules. That I think is also important to note, which in a way is twofold. On the one hand, it is that access to our instruments, among others those precautionary credit lines, is linked to criteria set in the Stability and Growth Pact. So if that pact changes, it would also be kind of natural to then, in a second step, look at the eligibility for our instruments and do the corresponding adjustments, or again, have this reflection, what it is that we need to have a resilient permanent crisis resolution mechanism in the euro area to make this work. Second element is obviously, and here I share those concerns that are out there on debt sustainability, the effectiveness of the framework, because obviously our work is based on debt sustainability as a core point for financial stability, and that is also why we want those rules to be effective and really to work, which I think also means they need to work for both fiscal discipline and growth. And as we heard this morning, and as such, there is no dissent on that, there is consensus on that. It also, what I can fully support is what was said from a market perspective. Market wants to have guidance on how they think about public finances, and that we would give ourselves at the grace of markets if that is not provided in time. That is why also we think it's very important to make progress in these negotiations in order to create clarity for citizens, obviously, but also for financial markets. And in order to have guide expectations in this period where still is quite some uncertainty on how the economy will really evolve and what the challenges will be. Now, on the point of safe assets, my reading, our reading, and we are a lot in financial markets or financial markets, is what it would take to establish indeed a European safe asset as a permanent benchmark would indeed be a permanent market financing. That is what it would take, which is not in the cards for now, and also not with the European Commission, because Next Generation EU is temporary.
Exactly.
This is a fact of life, and that is what financial markets are seeing, at the same time what they are requesting. And we're not saying that you need to give in to this, but I think it's a part of the reality. You alluded also to the fact of the spreads existing between the German rate and supranationals, including the EIB, European Commission, and ESM, and that is sometimes read, particularly for the European Commission, also as questioning the creditworthiness of the institution. I would recommend have a look at the rate of KfW, and you will also see an increase in the spread between the German rate and KfW, which is not of the same magnitude, but which tells you that there was something different than creditworthiness, because the creditworthiness of KfW has not changed at all. It's backed by the German government. So, which is just to say, be cautious on jumping into conclusions. There were market forces that kind of led to this increase in spread, which had also to do with the more general market environment, and it's not predominantly the creditworthiness of the institution that is driving it.
Thanks for making that point. Actually, I would also recommend reading a paper on this that we wrote before the summer for the European Parliament, where we actually discussed the driver of the increase in the spread. It's a bit technical, but for those interested in this topic, it's a bit the advertisement time. I recommend reading our paper on this topic. I just had a tiny question related to what you just said, because you mentioned that the ESM, in the end, access is related to the fiscal rules. But if I remember well, in the reform of the ESM treaty, when you wanted to reform the precautionary credit lines, one of the condition, or called quantitative benchmark, was actually related to one of the current fiscal rules, which is the 1/20th debt rule. Do you plan to, if we change the fiscal rules, is it going to be changed? Or actually, do we need to reopen the treaty negotiation to do that, or it can be done easily?
So, yes, you are right. It's mentioned there. There is no automatism between changing the fiscal rules and changing access to our instruments. This is a separate decision that has to be taken then at the time by the Board of Governors in order to implement it. We don't need to re-ratify the treaty because it is part of, so to speak, the annexes, and so you don't need to go back to the entire structure. Having said that, if you really change the fiscal rules, I think it would be a natural starting point and natural to also think about that criterion, because otherwise you create inconsistencies and frictions in the system. So that is certainly then a discussion to be held.
Definitely. Okay, we talked a lot about fiscal rules in the end, so I want to ask a question that is on Slido by actually my colleague Maria de Mercis. And to come back actually to what Judith and Alexandra mentioned in their introductory remark, and she makes a good point, is that we have been talking a lot about strategic investment in the EU, but the EU is different from the US, and we know that what has happened in the US with the Inflation Reduction Act is playing an important role here in Brussels when discussing about strategic investment and climate investment, etc. But how can we make the strategic investment in the EU without taking the risk of jeopardizing the single market? I don't know, want to take that question? Judith, maybe, or Alexandra?
Well, maybe I give an answer to the second part of the question. Maybe you want to allude to the first part. That was the core of your intervention. How can we prevent jeopardizing the single market by applying state aid rules? I mean, that is the tool to save the single market from being jeopardized by investments in single member states. So that's my simple answer to that.
So we need strong competition authority.
Yes, always. Sure.
Yeah, of course. Okay.
Yeah, I mean, the way I understand the question is, of course, we need to be careful about the fact that different countries have different ability to invest and to make these strategic investments, and we should be very careful to preserve, to avoid some kind of fragmentation and yes, that's absolutely key.
Okay.
But may I come
Yeah, of
back
course.
in again? But therefore, I think it is important that we have that we get the discussion about the fiscal rules right, because the purpose is to contribute to fiscal resilience, which then enables member states to make their choices.
No, I agree on the objective of getting the fiscal rules right.
And if I may, so we have been discussing a lot those, yes, strategic investment, European public goods, however you want to call them. But as you said, not everything will be financed. Both of you, actually, you all agree on that, that not all of it will be financed through the public sector. So maybe it's a question for Andrea. How can the public sector find the right incentive for the private sector and for big financial players to really go into that and really finance the transition?
I believe there are very strong market incentives for that. Every private group, large group, is significantly engaged in green investments, and by the way, Generali issued a significant green bond yesterday. And those incentives are coming, first of all, from the ability to attract young people. Young people want to see that in every private company, and your ability to be attractive is very much linked to that. And second, because, I mean, the insurance industry in Europe is a very large player. I mean, globally we're about, in Europe, just in Europe, 11 trillion euros of investments. And so when we move our investments, we can have an impact, right?
Yeah.
And but our groups ourselves, we fund ourselves in the capital markets, both equity and fixed income, and we know that we're strictly monitored by other investors in terms of what we do, in terms of green transition, in terms of sustainability and so on. And if we do not, and there are ratings and you know all this, so if we do not comply for that, we're going to be penalized by the capital market. So there is a market incentive for us to then, needless to, I mean, I don't think I can spend time to say how much Generali is doing in this area. It would be a bit boring.
Thanks. Alexandra or Judith or anyone actually, do you want to add something on this? On the incentive by the public sector, whether it's financial incentive actually or regulatory incentive to push the private sector to finance the transition?
I mean, I think what you said is key, that there is already a lot of market incentives to invest for the private sector to invest in the green transition. I think, of course, we should make sure the environment in terms of regulatory and incentives are right. We should not, I mean, but we should not also go too far in the sense that, there is already market incentive, so the public sector should not also kind of over-subsidize the private sector to go in direction where it's already going. So public sector should focus on the part that it has to do itself, the public, renovation of public buildings and all the kind of things that only the public sector can do for sure. That should come first.
Yeah.
And then, of course, kind of do the extra mile where it is needed, but a lot of the market incentives are in place already.
If I may just add from our perspective, where I think it also goes into the question of sustainable public finance. I mean, my reading of the literature, my understanding of the policy discussion, among others by Bruegel, is that the main market incentive is proper energy pricing, for example.
Yeah.
That's the main incentive where markets need to be guided. This is how expensive energy will be in the future. That is why you should direct your investments in that specific area. And that is where there need to be clarity. And if you get that clarity, you also get some clarity on the revenues that you can expect and the expenditures that you have to do, and the complementarity, obviously, of the private sector with the public sector, where the private sector needs to do more. So that, for me, goes then beyond the regulatory aspect. That's obviously right as well and needs to be addressed. But I think there is also priority here.
No, very good point. Yeah, carbon pricing in particular is very important. But as we know, it's difficult to implement it politically. And as we saw in the US, they have not chosen to go towards that path. So should we do it at the EU level is an open question. We're already doing it, but should we do it further? I realize that actually we are already running out of time. I don't know if you have last words, like 1 minute each, or...
You want?
No, Judith, actually, you wanted to add something. I saw you wanted to. So
To the last question, just quickly, Rolf made a very important point on energy prices, and just to throw one word in, we haven't discussed European Investment Bank, its role, and the value of initiatives such as the European Tech Champion Initiative, which I think are very, very good initiatives to attract private investment, but also give this incentive.
Yeah, no, it's a pity we only have 1 hour. Alexandra, last words?
No, just try to see what we have in common and try to focus on that for the discussion going forward. I think that's...
Well, if I had to say one word about the future of Europe, I would do everything possible to remove the veto power and move to a majority rule. I think that would allow...
In which area in particular?
No,
all.
I mean unanimity criterion has to be...
But for all topics?
Yes, I think that would really change.
That would be...
On that one, just also kind reminder of, remember that the standoff in the US Congress on the debt break or the debt rule in the US. So it's also not simple everywhere else. And so when it comes to politics, I mean, my last word in a way is very much in what I said at the start. I think we should take all pride of what we have achieved, also in terms of making Europe more resilient, but it's also a great moment to think about fitness for the future. And I hope not only on the fiscal rules, but also in other areas we can really make progress.
Thanks very much. I guess we could really continue this conversation for 1 more hour. Unfortunately, the session is over. So I want to thank very much the 4 speakers for participating and sharing your insight to our audience and for replying to my question. It's been a very stimulating discussion. I think it's only the start of the discussion. So thank you very much. And we will have now a 15-minute break before the next session. Now it's not even 15 because of us, so 10-minute break. And then we'll come back to discuss actually about trade issues with Richard Baldwin. So please come back to the next session. Thank you very much to the speakers.